talk to you about the subject of interest and how to explain it. The American writer David Foster Wallace gave a famous commencement speech at Kenyon College 20 years ago, in which he addressed the graduating students with a parable. Two young goldfish are swimming along, and an old goldfish comes past them and says to the young goldfish, "How's the water?" And then the old goldfish swims on, and one of the young goldfish turns to the other and says, "What's water?" Because the little goldfish hadn't been thinking about water. It was all around them, too obvious for them to notice. And Wallace was giving this parable because he wanted to talk about the importance of education and how it presumably surrounded every aspect of the graduate's life. You prefer this, yeah? So Schumpeter says of interest that it enters into every calculation. Irving Fisher, the great American economist, sort of, if you will, the founder of American monetary school, describes interest as an omnipresent phenomenon. Jim Grant, the financial historian and journalist, refers to interest as the universal price. So you get this, you're beginning to get this impression that certain people, thinking about interest, have considered it important and pervasive. It is also a subject that has been neglected over the years. Eugen von Böhm-Bawerk, in his book Capital and Interest, quite a weighty tome, I'm not sure if anyone in this room has read it, but his comment there that the question of interest has long been the object of contemptuous neglect. Böhm-Bawerk, who I think Mises was in his seminars, as I know, wrote the famous book on interest, and interest is an essential aspect of the Austrian school. But as the Austrian school got pushed out from academia in the 1930s with the rise of Keynesianism and then the post-war fusion of Keynesianism and monetarism, both the Austrian ideas of interest, but also the very understanding of interest became neglected. As to why interest exists, I'm listing some of the ideas that Böhm-Bawerk suggested. Fructification theory, the idea of something producing fruit over time. In fact, actually, you can see that in the early etymological origins of the word interest. For instance, in ancient Mesopotamian, the word mash, meaning a lamb or a kid goat, or tokos in Greek, the word for interest being a calf. The idea of, and even in America in the early 19th century, farmers were lending their cattle in exchange for receiving the interest of the cattle back and an interest of a calf at some stage in the future. And that must always be the case. Anyhow, there are other, I won't go into it, the other ideas, productivity, the use theory of interest. If you were going to use someone as property for a period of time, be some compensation, remuneration, exploitation, that's a nice Marxist idea of interest, but also has its roots, the idea of exploitation in ancient Greek philosophy, Aristotle in biblical and Islamic injunctions against interest, reproductive theories, and then what Böhm-Bawerk calls various colorless theories. And Böhm-Bawerk, I suppose he begins a sort of, tell me if I'm wrong, he begins a sort of the polemical tradition in Austrian economics, dismissing these so-called colorless and other theories, and inclining to the all-pervasive time theory, time value of money, or time preference theory of interests. Where I actually differ from Bernbauer is that I'm inclined to Irving Fisher's comment that I cite here, which is that the theories of interest which have been presented as antagonistic and mutually annihilatory are in reality harmonious and complementary. I mean, that, in this room, that might be a contentious comment. I think you could, if you want, have a hierarchy of ideas about what why interest exists, and if you want, put time preference at the top of that apex. But these other notions of interest, I think, provide you with insight. At least they did to me. The first thing we observe, or at least I observe as a historian, and here, I don't know if you can see this chart. This is a chart going back 5 millennia, and it shows short-term rate of interest with the data taken from originally taken from Homer and Silla's History of Interest Rates, a very fine book if anyone's interested in getting hold of the data, and then the later data filled in by the strategists at Bank of America. My starting point is that if we have a phenomenon that has gone back so far, and that goes back 5 millennia, and that's to the earliest dawn of recorded history, and we can infer from these etymological roots of interest that I mentioned earlier that interest existed in prehistoric periods through the loans that were taking place between farmers, that there is something essential to interest. It is not just merely a contingent financial development. In fact, the Yale historian William Gertzman, who I don't really agree, wrote quite an interesting book called "Money Changes Everything," it's a long financial history, which I don't think many people in the room would agree with a lot of the tenor of Gertzman's arguments, but he does make, I think, a good point where he says the invention of interest is the most important invention in the history of finance because it allows people to transact across time. And all economic and financial activities take place across time. When Aristotle denounced interest, the denunciation that then was taken up by the church fathers and entered into the medieval, and Thomas Aquinas and the medieval scholastic denunciations of interest. What Aristotle is doing is he's saying that interest is unjust because more is demanded back than has been given, which on the surface seems like a reasonable objection. But what Aristotle is ignoring is the dimension of time, that the loan of interest is for the use of something for a period of time. If you made a loan and simultaneously demanded the repayment of the loan with a supplement, that would be undoubtedly unfair. Given man's time preference, given a scarcity of goods, given private property, a person's right to enjoy their own property, but also to lend their property to someone else for a period of time, it is legitimate that interest should be charged. It's not only legitimate, but you cannot have an economic system or a financial system that operates without interest. You go back and look in ancient Mesopotamia, they have a real estate market, they have foreign trading, you have loans on houses, you have loans on mercantile ventures. The loans on mercantile ventures yield a higher rate of interest because embedded in the rate of interest is a risk premium. So already 5 millennia ago, we're seeing interest reflect risk, which I'm going to discuss a bit further. We're seeing a real estate market develop, and you could not have a real estate market without without an interest or a way of discounting it. And that takes me I'm going to run through what I see as some of the main functions of interest. I'm going to start with the notion of valuation. Now, anyone here who's trained in finance or economics will be aware of, almost the first thing one learns in investment is how to do discounted cash flows and internal rates of return, of applying a discount rate to future cash flows. So what is capital? Capital is the current value of a future stream of cash flows discounted to its present value, if that makes sense. And one could argue, I think I would argue, that anything that doesn't have a stream of cash flow potentially, possibly has no use and therefore isn't actually capital. And the French word for capital in the 18th century was actually intérêt. So in France, the British word at the time for capital was stock, but in France the word for interest and capital were actually synonymous. The time value of money, quite obviously linked to notion of time preference. And one way of understanding that is provided by Mises himself, where he says an apple in 200 years' time would be worth the same as an apple today without a discount rate. You have to discount the value of something in the future to get back to its current value. Otherwise, everything has, every object over time, however far out, has the same value as an object today, which, as Mises says with regard to these apples, is an obvious absurdity. And this was understood by the early English writers on economics, or what they called political arithmetic, where they understood that actually if you didn't have an interest rate or discount rate, you could, that properties, and in this case, I think Sir William Petty was writing about fields, that one acre of land and 1,000 acres of land would be worth the same unless you had a discount rate. Otherwise, so what that is telling you is that without the discount rate, every valuation rises to infinity. Now, I've shown here a picture of John Law, who some of you will be familiar with, the great financial projector, economist, founder of modern central banking ideology, and the progenitor of the Mississippi bubble of 1719, 1720. Now, interestingly, first of all, is that Law had a very acute sense of discounting. In fact, he wrote in 1703 in his essay on a land bank, "Anticipation is always at a discount. £100 to be paid now is of more value than £1,000 to be paid £10 a year for 100 years. Now, the other thing interesting, I mean, many interesting things about Law, is that he, when he went to France, created what was first private bank, the bank Banque Générale, and then turned it into the first central bank in France, the Banque Royale, is that law aimed to generate prosperity in France by bringing down the rate of interest. In 1715, when he first made his proposal to the regent of France, I think interest rates were about 6 to 8%. France was very heavily indebted, and law took over with his Mississippi Company the entire French national debt and a lot of other activities as well, including the Louisiana Company that owned 2/3 of the current United States. He absorbed all this debt. His central bank issued money to buy shares, issued money to fund the acquisition of shares that purchased the debt, and he brought down the rate of interest from 6 to 8% down to 2%, which simultaneously pushed the price of the Mississippi Company stock up from 500 livres to 10,000 livres. At 10,000 livres, it was yielding 2% dividend yield, but also price earnings ratio because it paid out all the profits. And when people said at the time that the Mississippi Company looked a bit toppy, a bit like one of these AI stocks today, law said no, the valuation was justified by reference to the current rate of interest. The reason I'm telling you this is two things. One, when I then looked back over the great speculative manias of history, one could find that most of the great manias coincided with periods of easy money, with abnormally low interest rates. And even, I think, I'm not 100% certain, but even I think the tulip mania of Holland of 1636, 1637 seems to have coincided with a lot of foreign capital flows coming into Holland to be deposited at the Weefsel Bank, which led to an increase in circulation of money. I mean, there's someone going to correct me here, but that it led to an increase in circulation of money and the decline in interest rates. I can't quite get the interest rates exactly for that period from Homer and Silla, but there's definitely a sharp decline of interest rates in Holland in the 1620s and 30s. Anyhow, you go forward through that. Mississippi bubble, I just mentioned, South Sea bubble takes place at the same time. And you run forward 1820s, 1920s, and so forth, right up to the current day. And the great bubbles coincide with this period of easy money and depressed interest rates. And I think that gives one a slightly different take on the speculative booms than the pure behavioral explanations for the bubble, extraordinary popular delusions of the madness of crowds. These are extraordinary monetary activities that serve to induce the bubble. And in recent years, in case any of you missed it, we had interest rates stuck at negative levels in Europe, which was an extraordinary development. Had never happened before in 5 millennia. And if something hasn't happened in 5 millennia and happened suddenly, that's going to tell you, at least it tells me, that what's taking place is extraordinary and deserves observation. So you had these negative interest rates and zero rates in Britain and the States. And this coincides with the appearance of the so-called everything bubble. A bubble in all assets. In real estate, in fine art, in vintage cars, in tech stocks, in venture capital investments, you name it. And that bubble, the everything bubble, burst in 2022 when interest rates rose, and the collapse of that bubble was interrupted by the sudden enthusiasm and interest for artificial intelligence. And that is rather anomalous the appearance of a new tech bubble just as another more general bubble is collapsing, but there we are. Interest also affects how capital is allocated. Interest informs the hurdle rate for your investment. What is your required investment? What is your required payback time? As you will know, the Austrian theory produced a link between the interest rate and the length of production. What this means is that as interest rates decline, people will be prepared to tie up their capital in longer productive processes. Now I think I have it right that that's also a view of W.S. Jevons, who the English economist, who also simultaneously at the same time as Menger developed marginal utility theory. So that's an insight that's not purely an Austrian insight, but one can see it that as interest rates decline, people, as they say, will invest in more long-dated assets, and for instance, most obviously real estate, which is a long-dated asset, and so you'll see the very clear relationship between real estate bubbles and low interest rates, but also into venture capital, into what we saw in the last decade, a sort of flurry of investment into Silicon Valley, and we had these unicorn phenomenon, the unicorns being companies with unlisted companies with valuations greater than $1 billion. And as Jim Grant, my friend, said, a little known aspect about unicorns is that they feed on low interest rates. The lower the interest rates are, the more they like them. But there are other aspects of how capital was affected by the ultra-low interest rate era, namely, the very low interest rates actually, to my mind, slowed the process of economic activity by arresting Schumpeter's process of creative destruction. Now, Schumpeter doesn't say this, but there was a Yale economist, 19th century, called Arthur Hadley, who adopted a sort of Darwinian or Spencerian view of interest, which I quote here, that interest helps the natural selection of the most competent employers and the best processes, and the elimination of the less competent employers and the worst processes. So there is in Hadley's view, and I think it makes sense, that the interest sets a hurdle that will push inefficient businesses out of operations. But at ultra-low interest rates, we got this zombie corporate phenomenon, a phenomenon that was actually first widely observed in Japan in the 1990s, also a period in a country where interest rates had been brought down very rapidly after the great bubble in Japan of the 1980s. And the point is that in Japan, the very low interest rates were part of a broader process of loan forbearance, of the banks not pushing for the repayment of non-performing loans. But so I think the way to look at the ultra-low rates is that they are in general a form of loan forbearance that keeps inefficient companies in operation. And various studies show that if you keep these businesses in operation, they will reduce the profitability and productivity growth within those industries, discourage new entrants, and discourage productivity growth. So the more you spread the zombie phenomenon around with the low interest rates, the more you are likely to impair the economy's capacity for productivity growth. And the consequence of that will be lower economic growth and lower income growth, and consequence of lower income growth will be over time, a lot of very angry people. Now, Ferdinando Galiani, 18th century philosopher, not, as far as I know, taken up by the Austrian school. But Galliani, who wrote a book called De la Moneta, made an interesting comment when writing about interest. He said that interest was the price of anxiety, and that the loan act of lending created anxiety, or at least it should do, in the part of the creditor as to whether the creditor was ever going to get paid back, and that no one should suffer anxiety without being compensated for. Now that was Galliani's rather roundabout way of saying what we would say in modern language, which is interest is the price of risk. And it's the price of risk, you can see this very clearly in these derivatives called credit default swaps, which are just really insurance premiums on corporate and sovereign debt. So embedded in every interest payment, including the so-called risk-free interest of sovereign debt, is a risk factor, and myriad, not just a credit risk factor, but myriad other risk factors as well, including inflation risk. What the 19th century financial writer Walter Bagehot observed is that when interest rates came down, people would take on more risk. And Bagehot phrased it, John Bull, he said, John Bull, the emblematic Englishman of good sense, John Bull can stand many things, but he cannot stand 2%. Faced with a 2% interest rate, people must either accept a loss of income, or they must be less safe. And that observation by Bagehot, which goes counter actually to modern finance theory, is actually supported by research. In fact, research that was done one of the Dutch universities and Harvard, which found that as interest rates came down, I think this must have been in one of these sort of university experimental settings, as interest rates came down, people would take on more risk. And those of us who worked in the financial world will observe, what we call, carry trading and the search for yield and the decline in underwriting standards that happened both before the financial crisis, when the US put in low rates, but also after the financial crisis, and led to great recrudescence of risk-taking in the last decade. That picture here is Nassau Senior, the first political economist at Oxford, and he had another take on interest, which is interest as a reward for abstinence, an inducement to save. It's not just that interest rates are inducement to save, but they coordinate current saving with future consumption. Higher rates encouraging more saving and boosting returns on savings, with low rates having the opposite effect. What you can see here in the chart, or we might be able to see, is that the period of ultra low rates in the States was coincided with a step downward movement in savings. And likewise in Britain. There were also building up during this period of ultra low rates huge problems for pensions, because the lower rates are either you're going to, put most simply, is the lower interest rates are, the more people will have to save for their pensions. This is a chart from Reinhardt and Rogoff's book, which shows movements in capital flows in the dotted line with banking crises. And I don't want to get you too into this, but basically capital flows from the core of the financial system to the periphery when interest rates are low at the core. In fact, the Dutch in the 17th century, possibly in the 16th century, definitely in the 17th century, were lending to Britain. Britain was a sort of emerging market as far as the Dutch are concerned. And I think the first English financial crisis followed from the Dutch removing their savings. I'm thinking it's sort of in the 1620s, but somewhere around that time. It was called a damp, which sounds almost Dutch word. But then there follows, over the following centuries, are definitely heating up in the 19th century, these periods of capital flows where capital flows into what we'd call emerging markets, famous example in the 1820s, when interest rates are low in England, lending to Greece and South America and so on. And then interest rates rise in England, the capital flows back, and you have a bust. Now, famously, the 1920s were also conformed to that period with massive capital outflows from the United States to Central Europe and Latin America. When interest rates are hiked in 1928, foreign lending to Germany and Austria ends abruptly, capital flows back, and you set up the conditions for the Kreditanstalt crisis and the collapse of the German banking system. Too much of the focus on history of the Great Depression is on the Wall Street bust and not enough on this capital flows and the reversal of capital flows. And if you think, I don't want to go over long, but the global financial crisis also conformed to that pattern, capital flowing, particularly to the periphery of Europe and Iceland, and then capital flows reversing, followed by a severe bust. I say actually Piketty's got the sign wrong, that inequality rises when the rate of interest is below the rate of growth, which happened in the period of ultra low rates, and that is because, as I've been saying earlier, if you push the interest rate down, you're going to push capital asset prices up, and because not just is that going to affect the distribution of wealth, but also distribution of income, because a lot of people's incomes, including bankers and senior executives, is tied to asset prices. And here, as a nice sort of illustration of that, I've taken the top 1% income share in the US, and I've shown it against the returns of a 30-year Treasury bond. And what you can see here, as the returns from the Treasury bond increase, in other words, as long-term rates are falling, inequality is rising. Okay, so now we get on to the nubber story. Interest. The modern central banker, policymaker, economist, conventional economist, sees interest merely as a lever to control inflation, and also as a lever that you can use to boost the economy and slow it down. There is no, as far as I can see, there is no deeper insight into interest there. Their models contain an assumption of time preference, but it's sort of glossed over. They think that and this goes back to a Swedish economist, Weefsel, 19th century, late 19th century, the idea that there is a natural rate of interest which would exist in a world without money, and that you can tell in a world with money when the central bank has set the interest rate wrong, whether you have inflation or deflation. Now, Hayek argued with this thesis in his earliest work in the 1920s. So Hayek belonged to a school that thought that deflation, falling prices, was the inevitable and benign product of a productive economy. Think of it, with computer semiconductor chips becoming cheaper and cheaper, and then everything else being equal, you might expect the price of your computers to fall. And so the Hayekian view was that this focus on price stability, which actually, incidentally, Irving Fisher, who I mentioned earlier, he had a sort of there was a mania for price stability in the 1920s, and that mania came back over the last 30 years, this manic focus on avoidance of deflation, and a confusion between the good deflation of productivity gains and the bad deflation that occasionally follows a banking crisis. Whereas Bernanke, I'll show you here, the man of the year, the Time magazine, or person of the year in whenever it was, sort of 2009, 2010, who led the US into the greatest financial crisis since the Great Depression, completely oblivious to what was going on, and focused solely, both before and afterwards, on meeting his inflation targets. In the second period of the inflation target, there followed the zero interest rate policy and quantitative easing, some of whose aspects I have discussed. There's a long quote by Hayek, which I'm not going to give you, but I will end, and I will end on two comments, contemporaneous comments. One by late Charlie Munger, the sidekick of Warren Buffett, where he wrote, "Maybe we have a new version of Lord Acton's law, easy money corrupts, and really easy money corrupts absolutely." And the American investor, hedge fund manager who I know, called Seth Klarman, wrote a perspective comment in his letter to investors in January 2021, that the idea of persistently low rates has wormed its way into everything: investor thinking, market forecasts, inflation expectations, valuation models, leverage ratios, debt ratings, affordability metrics, housing prices, and corporate behavior. And moreover, by truncating downside volatility, forestalling business failures, and postponing the day of reckoning, such policies have persuaded investors that risk has gone into hibernation or simply vanished. Now, over the last 3 years, this is not the subject of the talk now, but over the last 3 years, we have gone back to a period of more normalized rates, and through that period, we have seen various ructions. Like 2022, the worst collapse in the bond markets, in the developed market bond markets, since the inception of the bond markets, the modern bond markets in Britain in 1750. So at that point, I think we've got 10 minutes left. I'm going to open up to any questions, and in particular, if anyone wants to vehemently disagree with something I said, I'm happy to hear what they have to say. So,
my question would be, and then I will give it to the audience, given all this, would your remedy then be a complete free market in interest rates and the abolishment of central banks and fiat money in general?
So
I think this one is
some reviewer of my book said, "Never have I seen such a long and lengthy complaint about monetary policy without a single suggestion of how it could be rectified," which is a fair enough comment, because actually I was just trying to analyze what I thought the problems were rather than offering a solution, in part because, having been a writer for 30 odd years, I notice whenever I offer a solution, no one pays any attention, definitely no one ever takes it up. So actually I gave up wasting intellectual brain power on providing solutions. I think, having said that what I take away from my book is that the central bankers will never know the correct rate of interest. In fact, apparently, and I think this is a forerunner school of the Austrian school, something called the Salamanca School, which is a medieval school of economics. And apparently their notion is that the just price, and I think we can include interest in that price, was known only to God. Now, we would say the same about the prices of any object, that we leave them to be discovered by the market. But in a world with fiat currency and fractional reserve banking, the problem is that you can conjure money or credit out of nothing. The act of lending by a bank, which is then the loan being redeposited in the banking system, produces its own savings. So that, if you will, the sort of elasticity of the modern monetary system means that the rate of interest that comes out, that appears, is not a proper reflection of the amount of savings and the demand for those savings. So, yeah, I think you would need to go to a different monetary system. I'm not sure whether, there were problems with the gold standard, not least that the blasted French hoarded all the gold in the 1920s, bringing, and the Americans had the rest of the gold, bringing the collapse of the gold standard and engendering the Great Depression. So there are problems with returning to gold. I was mentioning, I have this friend called Thomas Meyer, who's the former chief economist at Deutsche Bank. He moots what he thinks is a digital gold, which is a very strictly controlled central bank digital currency that would increase by a small amount every year and be like gold. People worried about the privacy implications of that, and we know that that when problems emerge, the politicians would probably tear up the rules as they've done with the ECB and increase issuance. You could move towards. Some people have hope of of new private monies, and it may be that the stable coin could form some. I mean, it would mean a rejigging of the entire banking system, which I'm not necessarily a bad thing. So yes, it would be a mammoth required reform, and there would need to be a huge amount of political support for that reform. And the society we live in, we can't really just blame the central bankers for their policies. The central bankers were enforcing policies that were demanded by the public. The public wanted to have their cake and to eat it, and the ultra low interest rates were a sign of that sort of civilizational malaise. And it's interesting that Baerbock says that the low interest rates, he thought, and this was funny enough taken from the observation of the Dutch, because Dutch in the 17th century had the lowest interest rates in Europe. They had advanced financial institutions, and they lent to the Brits and so on. And it was observed that Dutch culture was very civilized, and the Dutch were a very high state of civilization. So Baerbock did say that the interest rates were a reflection of the level of a civilization. But in fact, if you'd come back today, then the low interest rates to me looked like a reflection of a civilizational malaise. And interesting, I'm veering off your top. Interestingly, in the Homer and Scylla book, you see a U shape for interest rates in various civilizations. So that the Mesopotamians or Babylonians, the interest rates start high, come down, and then they shoot up. So my view is that the ultra low interest rates are a late civilizational thing, and that we have willed them, and by willing them, you'd have to have a huge shift to will a different system, perhaps a hyperinflation or something. I don't know, but we're certainly not anywhere near that now. No, I don't think so. I mean, I don't think so. First of all, as I mentioned to you, from a purely theoretical perspective, Knut Wicksel's idea was that imagining an economy without interest, so without money, and you would still have an interest. So say if time preference is an inherent aspect of interest, then you will have interest in all types of society. Even one of the reasons, there's actually quite a good book on the Soviet economic system. I cite him, the author, in my book. We observed that one of the failures of the Soviet Union is they didn't have an interest rate to help allocate capital. So yeah, I don't think you need a continuing expansion of the money supply. When you say it has no place in sense of isn't considered.
It's not considered at all.
Yeah, no, I think that is. It's funny enough, actually, the Dutch had you had a central banker up just before the financial crisis who was called Newt. I can't remember what his name is.
Velling.
What?
Now it's Velling.
Velling, yeah. So he actually did seem to be thinking. I remember reading his. He was worrying about real estate prices and credit growth. So, but yes, I think the trouble. I mean, I'm not. I don't know how these DSGE models work. I never looked at one. I just read them at second hand. But yes, one. I think that there is a. They didn't pay attention to asset prices. That Bernanke, I was mentioning earlier, he in 2005 he was saying that high U.S. home prices reflected benign fundamentals. The rest of us, I mean, I was writing journalism in America. It was quite clear. We knew about the subprime stuff. We knew about the liar's loans. We knew about the negative amortization loans. We knew about people flipping houses. I mean, it was an absolute, pure, obvious bubble that was particularly threatening, as I mentioned, from Borrio's perspective, and the central bank knew nothing about it. And amazingly, in 2008, going into the financial crisis, Lehman bust, there was not one person on the Federal Open Markets Committee, the main board of the Federal Reserve, who had any banking experience whatsoever. They were all pie-in-the-sky academics. As for these inducements to foolish behavior by ultra-low rates, I mean, because we're engaged in these constant sort of intertemporal activities, saving today or borrowing today, consuming tomorrow or repaying your loan in future, if you bring the interest rate down, you're creating incentive to borrow from tomorrow into today. And that you see, I would say over the last 25 years, up to 2008, the incentive was on the households to bring their consumption forward. Households in many parts of the world were so badly hit by financial crisis that they then delevered, whereupon the governments brought their spending from the future forward, as evidenced by the extraordinary growth in public debt. And for instance, my view was that lockdown, to me, one of the most socially destructive and exaggerated, ineffectual policies ever seen, that was entirely engendered by the ultra-low rates. Take, for instance, Britain. British deficit 2020 was around 15, I think, or 17% of GDP. Absolutely normal, like a wartime level deficit, funded by the Bank of England, in effect, at a cost of 10 basis points through its quantitative easing operations. Now, the bank, the British government debt is running at close to 100% of GDP, and the amount, the debt servicing costs of British government have quadrupled, and Britain, along with other countries, France notably, possibly the US, perhaps one day Japan, are moving to a state of financial crisis. The big crisis, probably, of the next decade will be on the governments. And that was induced, I think, as I say, by the extraordinary profligacy encouraged by the ultra-low rate periods. And then, on top of that, in the allocation of capital I was discussing, the misallocation of capital, you have all these bubble investments that take place. Now, another activity that I don't think would have happened is we wouldn't have had this push to so-called net zero, so the decarbonization of our hydrocarbon civilization within a very short time period, 15 to 25 years, whatever. You wouldn't have had that push if interest rates hadn't been so low, because the renewable energies, or so-called renewable energies, actually are immensely capital intensive. These wind turbines you see all over Holland, they have 500 tons of cement, 500 tons of steel, and huge amount of other material. Now, when interest rates were low, those investments appeared viable, to some at least. But then when interest rates rose, there's an energy consultancy called Wood Mackenzie. They calculated that every 1% change in the interest rates added 20% to the levelized costs of renewable energy. So there's a clear link, to my mind, between the seeming attractiveness of this move to renewable energy and the interest rates. And now you'll find, if you look at any of those indices, that those markets are all, in the stock market, those are all down 70 or 80%. So to my mind, we definitely had a green bubble that was engendered by the ultra low rates. On that topic, we could go on for all of today, tomorrow, and probably a bit into the next day.
First of all, another round of applause, please.